Welcome to the daily update, where I'll go over the action in the market for Thursday, July 3rd, and we'll see how things look for Monday, July 7th. I want to wish a very happy 4th of July to everybody. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. And the market is looking pretty solid right now, maybe a little too solid. We're starting to get exuberant as far as sentiment is concerned. It seems like any news that comes out right now is treated as positive. Any weakness we're seeing buy the dips. And it's getting to that point where, all right, the market's starting to be taken for granted. Now, we can still go up from here. There's nothing to say that it has to turn at any point once we get a little exuberant, but we're seeing a lot of things coming together. We've got a holiday weekend. There's potential geopolitical things that could always come to the forefront. There's things that could happen in the U.S. Hopefully, everything is good and everybody makes it through the weekend just fine. At the same time, it's like, okay, people are just kind of throwing money towards the market and it seems to be going up. And that's when we have to be a little bit careful. All right, so right at the open, the employment situation report was taken as positive. And who knows, it might have been taken as positive no matter what happened. Now, it could have been taken as negative too, because with the solid employment report, that pretty much means the Fed is not going to cut rates, which was producing some of the exuberance that we were seeing earlier in the week, because we're getting, for the most part, weaker than expected economic reports, but the employment is holding up. So we jetted up after the employment report came out. There was a whole slew of other economic information that came out. So we gapped higher above. We actually opened above R1 at 62.41. We got up above R2 at 62.54. We didn't get up to R3. I had that calculated, but we didn't quite get up to that level. And then prices actually climbed above the 62.75 level, and we held the gains. We didn't see a lot of selling into strength. We just kind of drifted as the day, even though it was shortened, as it unfolded, and we closed slightly below the intraday high. So we were up 0.83% on way below average volume, because there were 3 hours out of the day that didn't happen, and so that's going to really bring volume down. So we're positive on all time frames. We are trending, but we're getting a little overextended. We'll see if they come back over the weekend. Maybe everybody has a really happy 4th, and they're happy how their stocks are doing, and they're saying, okay, let's lock in some profits, and maybe we'll see some kind of a decline. But that's still a few days away, and anything can happen. So we are looking positive. Interest rates are going back up. That's a little bit of a concern. We got a little bit of a bounce from the dollar in Thursday's session. Growth is leading right now, and that's when we see the market doing well. Mega caps are doing well. But we want to be aware of geopolitical things, not only between Iran and Israel. Things could always spark up between Russia and Ukraine. Of course, India, Pakistan is always in the background. And then something else that was unforeseen, and then something domestically that might happen in the U.S. So, some comments. The employment report was better than expected, and this is still holding up for right now. And the Trump administration has rescinded its restrictions on the export of chip design software to China. Now, from a business standpoint, that's a good thing, and that helped tech, and that helped the semiconductors. Other people are concerned about this from a security standpoint. It's like, okay, we're sending our high-end technology over to China, which they may try to re-engineer anyway, but is that good from a security standpoint? And the debate goes back and forth about that. Mega caps and growth had a good day. And then our short-term list. Now, we do have the usual charts, the Stochh RSI, 1%, our CCI charts, and the stochastics. When we're showing any kind of positive momentum, these are on the list. But now we're seeing the list expand, where the advanced decline ratio, both based on price and volume, are starting to look extreme. We're still far away from the 20-period exponential moving average on the S&P itself. Our momentum oscillators are turning back over. We're looking better with the long-term oscillators, but we're positive with the short and intermediate term, with the slope oscillator already being extreme positive, and that's a short-term one. We're still far away from the 20-period moving average, and the short-term RSI is extreme. Intermediate term, pretty long list here. We're also getting far away from, or we're looking extreme from the 50-period exponential moving average. Then later on, we are getting extreme away from that moving average measured by the boom indicator. We're even above the +3 channel. I don't have it on the chart, but we're actually into the +4 channel with standard deviation. And that's strange. That doesn't happen very often. It's happening now, though. The CMB composite, the rate of change going back 50 periods, that's been on the list now for quite some time because it's still calculating back into those much lower prices back in early to mid-April. And now we're seeing the McClellan oscillator for the S&P looking extreme. That's short to somewhat intermediate term, but I still have it on the intermediate term list. The momentum oscillators like the PMO, positive but extreme, and a lot of our other oscillators as well. The Sean trend meter, the percent B, we're still looking above that upper Bollinger Band, and both the NASDAQ and S&P 500 bullish percent indexes, as well as the ultimate oscillator, the intermediate term RSI, the Chaikin oscillator, and the advanced decline oscillator as well. And I'll show all the charts here. The only thing that's really changed as far as the scenario, at least after Thursday's session, is that it's less likely that there was some talk, there were some rumblings, but the market really wasn't doing anything itself about this, that there might be a rate cut. Week before, a couple of Fed people came out that are on the FOMC and they said, well, we'd be open to a rate cut. Well, that's pretty much off the table right now. And then the dollar was up slightly, but it's still it's still in a solid downtrend, and it's been seeing some real weakness, which has been helping stocks. Interest rates are up. We're at 4.35%. Now we're getting closer. Just a few days ago, we were under the 4.25% level. Now we're going back up. If we get to that 4.5% level, that might produce some problems. And sentiment, we're extreme positive. We're at 78. We jumped all the way up from 63. And that's positive, is 63. Now, when we get to 75 or above, now we're looking extreme positive. And this is when the warning flag goes up and just says, okay, maybe everybody's too positive right now. We're not exactly sure how this will unfold and what's going to actually unfold or when. We just are ready to say, okay, everybody's positive. Now it's time for us to be a little bit more pessimistic about things. And we are trending, though. We are in a positive trend. It's a confirmed trend, both on the short and intermediate term measurements that we use. With the update, our bias is positive and the momentum is positive. So we got a pretty long list here of economic reports. It was a big day because we had some reports that usually come out on Friday, came out on Thursday. The big one was the non-farm payrolls. Much stronger than expected. They expected 120,000 in growth. We got 147,000. And I'm also watching the numbers from the previous report. These were actually revised up. The last couple of reports that we've seen, they've revised the previous months down. So this is also showing a little bit more strength. Now, this actually came in weaker than expected. The private payrolls were 74,000. They expected 123,000. The revision was not changed all that much. It came down at 137,000 where it had been 140,000. But this is private, and this is actually seeing some weakness here. The unemployment rate did tick down. That, again, I say this every time. It's so manipulated that it's not really all that useful, but politicians, the media, people like to quote it because it's one number and you can just say that number and it's supposed to give an idea of what's really going on. We're at 4.1%. Last time we were at 4.2%, which is what they expected it to be this time. The average hourly earnings ticked down, which is not necessarily inflationary. It's actually going down. It was up 0.2%. They thought it was going to be up 0.3%. Last time it was up 0.4%. The work week did tick down to 34.2 hours from 34.3, and that's what we saw last time. Now we had the trade balance come in a little bit more than expected, 71.5 billion. They thought it would be at 70.5 billion. Last time it was at a minus 60.3 billion. So we're seeing that actually becoming more imbalanced there, the deficit. And then we had the weekly claims, which actually came down. And this is actually more close to right now, is about as close to real time as we can get because we get these every week. Where the big number is what comes out every month. But then every week we get the initial claims, which were down at 233,000. They thought it was going to be at 244,000. Last week it was at 237,000. The continuing claims were the same. Now they're still below 2 million. When we get a little more concerned is if it goes above 2 million, but this is still rather elevated, suggesting still the scenario is that companies are more reluctant to let people go, but the people that do lose their jobs, they're staying unemployed a little bit longer. Okay, and then the global services, this is really not that impactful, but the takeaway here is that it was above 50, even though it was down from the previous reading. It came in at 52.9. Last time it was at 53.7. Then factory orders were up 8.2% and stronger than the 7.9% growth they had expected there. Last time it was down 3.9%. Then the other big report were the ISM services, or non-manufacturing. We were below 50, and when we had this report last month, this was a bit of a concern. That shows contraction when we're under 50. We're back above it, and we even came in a little bit stronger than expected at 50.8. They thought it would come in at 50.3, or last time it was under 50 at 49.9. Okay, so here are some charts. Here's the non-farm payrolls. Still holding up fairly well here when we look at the longer term number of jobs. The let me try that again. The hourly earnings year over year is declining. So it's actually coming down a little bit here, which that sucks if you're an employee, which pretty much all of us are, but it's good from an inflationary standpoint. We're not really seeing this spike up all that much. And then the trade balance is less than what we saw before, but this is the 3-month average where it declined from the last reading, but we're seeing that really lessen. And this is probably being impacted by the tariffs. And then imports and exports year over year, the blue line, those are the exports. Those are going down where we're flat with the imports. And then the trade deficit coming down a little bit here more than what we were seeing last time. It's always negative. And then factory orders really came up here on a year-over-year basis. We've been chopping right around a little bit positive, a little bit negative. Now we're seeing things pick up. Now that's showing economic strength. And then the durable goods orders also really increasing as well on a year-over-year basis. Non-durable goods just coming right back up about to the zero level. And then when you take out aircraft, we are above zero and going up. Not really seeing much of a breakout there, but it's still positive. Then the non-manufacturing or services, or the blue line, it's still above this 50 level, even though it did tick down a notch here. The prices are coming down, and that was seen more as market friendly as well. When the prices are coming down, that's not inflationary. The unemployment rate at 4.1%, and then putting it all together here, the red line are the initial claims, which did decline. We're still rather elevated with the continuing claims, and then the new unemployment rate at 4.1%. And then the weekly claims here did decline, and that's taken as more positive, where we're still rather elevated with the continuing claims, even though it was unchanged from the previous week. All right, and looking at real investment advice from Isabel Net on their blog, looking at the annual change in the S&P, that's the black line here, and then the reported GAAP earnings. This is the generally accepted accounting principles and the annual change there as well. And then we have the reported earnings year over year, and then in blue, this is the rate of change. And again, this fits into the overall scenario that earnings drive stock prices. So if this is looking more healthy with more of the blue going up, then the red dashed line is also projected to go up as well. Okay, then another bullish sign. This is put out by Carson. What are the returns of the S&P after there's a golden cross? And we saw that this week for the S&P 500. If you go out 1 month, we're up 59.5% of the time in a positive return. And then it starts to look better when you go 3 months out, 6 months out, a year out. That just means the bigger picture trend is more positive. And then consumer sentiment index and subsequent 12-month returns, how people are feeling. When they're feeling better, the stock market tends to feel better. And we are improving after we had been feeling more negative about things. And then the intra-year declines and the calendar returns. So we had, on an intraday basis, the S&P fell over 21. And that was, it has it down here at 19% because that was a closing value there. I look at the intraday as well. And then we were down 19%, and now we're at least, and this is before Friday's session, so we're up almost 6% now. But according to this, we still are back in the green and up with a positive year-to-date return for the S&P. Earnings growth, and then we're focusing right here on 2025 here, where they're down from previous readings. And I keep saying this all the time, but they're still positive. When you look at the Magnificent Seven, they're still the real drivers of the market. And then you take out the rest of the stocks in the S&P, they're still looking positive, and then the projections are looking better. Not great, but still looking okay when we're looking out to 2026. And this is what the market uses. They focus on forward-looking earnings and whether they're revised up or revised down. Then concentration, the market cap. Okay, 10 largest companies, 38% of the overall stock market is in the 10 biggest companies, with 30% based on earnings anyway, coming from the big companies. And then federal debt held by the public going all the way back to 1900, okay? And it's increasing. And these are bonds, which are issued with different maturities here. And then the regions, evaluations. And I'll be going over this again in the intermarket analysis update, where we're still looking expensive with U.S. stocks. You take them together, generally measured by the S&P 500 at 21.9. We're probably closer to 22 with Thursday's gain. And that's well above the range that we should be in to be more fairly valued. And then comparing that to the rest of the world's valuations. Gold, not the dollar, is now favored by reserve managers. Well, yeah, the dollar's been getting hammered. Gold has been going up. So not a real surprise here from this Bloomberg chart. And then market implied U.S. recession probability, it is declining now. And I have another chart that I'll show in the weekly video that still shows that we're okay as far as probabilities for going into a recession. And based on what the market's doing now, our ratios that we look at, I don't show them here. I'll show them over the weekend. The market is anticipating that we will not go into a recession, and there's really not a concern about interest rates. Now, that could change, but we just go with what we see right now. And then target rate probabilities after today's jobs report. So this is a little more up to date. The markets are now pricing in 2 rate cuts in 2025 as the most likely scenario. And if you look at this, all these lines going all over the place, that's how you conclude what the headline said here. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, so here is the chart. We gapped higher above R1. We actually quickly got above R2. R3 was up here. We never quite got there, but just this is kind of one of those days where we see a smokestack here, and then we're just kind of drifting off afterwards, and held on to the overall gains, closing at a new all-time high and just a little bit off of the intraday high. And we're down a little bit. We saw the SPY dropping a little bit after the market closed. We were down about a quarter to a third of a percent, but now we have a 3-day weekend and things can change over that period of time. Things were very quiet. Everybody was really waiting for all the economic data coming out, specifically the employment report. And then that's why when we saw the real bump up here, and that led to the higher open. And still seeing pretty much a dead heat when we look at growth of value. Now, that's okay. We want the blue line above the red line. That's when we're seeing growth outperforming, and we're seeing that in our longer term charts. But if value does okay and growth is also doing okay, that just means there's more broad participation across the market. And we are improving with the S&P growth to value ratio intraday. It really took a hit right on July 1st where a lot of value was bought, and now we're seeing this coming back up as far as a ratio. So the end of day, growth was up more than value for the large caps, up more for the mid caps, and up more for the small caps. So a little bit of a bounce here with our small cap growth to value ratio, mid cap growth to value ratio, and S&P growth to value ratio. A little bit of a bounce up coming out most of the high end of the rainbow here with this growth to value ratio. Wanted to look at large cap growth, looking good, setting all-time highs, starting to cross with the moving averages, back to looking positive. And then discretionary, which is improving. It's actually holding up okay. And or here's discretionary up here where staples are under a little bit of pressure. So we're seeing the equal weight ratio here going back up. We came down, we held at the 200-day moving average, and we've been coming up from that. The longer we stay above these lines, the more we might see a golden cross with this ratio. And we are positive in the short term, the green line going up, the red line going down above the moving average and above 20. Also, the same thing, above 20, green line on top, going up with the intermediate term trend. And we dropped down here. And again, this is because it was a shortened trading day. But we have been above average for most of the days this past week, 3 out of the 4 anyway. We're still below 20 with the VIX, so that's helping stocks to be more positive. And we were up a little bit here with the VIX of the VIX. We're going sideways with the bar chart, but we ended up closing a little bit higher, but still below the moving averages with the line chart. And we're kind of drifting sideways, but mostly lower with the momentum of the VIX. We declined with this fear gauge. We declined with the other fear gauge. Confirmation there. We're seeing fear coming out of the market. The latest reading from individual investors, we're back to positive now. They're not extreme at this point, but they had come back up. They were positive, then they dropped back to negative. Now they're dropping or going back over to looking positive again. And this is surprising to me because over a 3-day holiday weekend, do you really want to not hedge? Now, there's another part of this equation. It could be people buying an awful lot of calls because the put to call ratio, when this goes up, that means there's more puts than calls being bought. And it could be people are still buying puts, but they're buying even more calls currently. So we're still going down with the 5-day chart, and we're below this red line. So this is where we start to look extreme here, extreme positive, even though it's a low reading. And we're really declining here with the 10-day average chart. And we're continuing to go up with the risk on to risk off ratio. That's really breaking out and looking pretty good there. The high beta to low beta, this is breaking out also. And here's another look at that same chart. Now, this is before Friday's session, where this previous chart, this is after Friday's session. So with this ratio, we're now setting a new all-time high. And these are the stocks that outperform. And when we're really going up, it's the NVIDIAs, the Googles, the Apples. They outperform when we're going up. Unfortunately, they also go down faster when we're in a decline. And then we are kind of drifting a little bit above the band here, coming down a little bit with the volatility risk premium, but it's still above the band overall, showing a little bit of apprehension there. All right, advanced decline line, setting a new all-time high based on price and volume. We're getting really extreme with the advanced decline oscillator. We crossed above 0 and we're continuing to go up. Again, it doesn't mean we're necessarily going to stop when we finally spike and start to come down, but we might slow down a little bit, and that's what we'll be watching in the upcoming week. It's relatively light as far as economic data coming out, and if the market's going to take a bit of a rest and start to go into the summer months and vacations and things, that's what we'll be watching, because that's what we saw earlier on when the market was not trending back in June. It's not that we were seeing an awful lot of weakness. We were just kind of going sideways and hit into a trendless environment. And then we were able to come up out of that. We'll see if something like that ends up developing as each day goes on. And we're looking extreme here with the short-term advanced decline ratio. This is just based on price, where we're just getting to the green line here based on price, but now we're getting extreme positive here based on volume with the short-term advanced decline ratio. Looking good here. A lot of new highs. We, for the most part, been seeing an expansion of new highs, really not any new lows. The 5-day and the 10-day moving average charts continue to go up. Looking good with our three smart money indicators. Now, the chicken money flow was a holdout after Wednesday. It's now back to positive. But here with accumulation distribution above the advancing moving average and the boom indicator is going up. Now, you might say here we're getting kind of far away from the moving average. Now, that's what the boom indicator is supposed to measure, but it doesn't really do a very good job of that. And with stockcharts.com, which is where I make my charts, I can't measure the difference between the indicator and the moving average. I used to use other software called Metastock, and I could do that, but I don't use that software anymore because the charts that they make are so ugly. All right, and we're back to looking positive here with the Chaikin money flow. This was actually flat after Wednesday. Now it's starting to go back up. And we are positive with the Chaikin oscillator, but now we're going above the green line. Now we're looking extreme positive. Again, other times when we hit this, it doesn't necessarily mean a reversal. It just might mean that we slow down a bit. And we're positive with the vortex, setting new all-time highs with the cumulative advanced decline line for the S&P based on price and volume, looking really solid there. And we're improving. We're coming back up to the green line. This is longer term, 10-day average of the highs and lows for the S&P. We were dropping even as the market was going up. Now it's starting to pick up that strength and really starting to improve. And the 50-day new highs, new lows, this is continuing to go up. That's longer term positive. Above all the moving averages with the advanced decline line studies, setting new all-time highs here with the cumulative NYSE advanced decline line and the regular NYSE advanced decline line, as well as this other slightly calculated differently advanced decline line. And the common stock setting a new all-time high based on price and volume. Really improving here with the NYSE advanced decline line coming back up and performing just as good, if not a little bit better, than the S&P 500 itself. We're above zero and going up with the 5-period moving average and highs and lows across the broad market. And we're back to looking just a little bit extreme here with those stocks in the S&P above their 20-period moving averages, improving, but not a big move here with the 50-period moving average study, 100-period moving average study. And this is actually more encouraging. We're going up further with further stocks being above their 200-day moving average in the S&P. We're a little bit concerned because this was lagging, but this is starting to show some improvement now consistently. Here is another day, another new all-time high here. The dash line, that's still the previous all-time high. I'm keeping that in here for a little bit now until we start to pull back at some point. And then here are the pivot points now for July and even into August. Recent golden cross with the S&P 500 where the 50 crosses above the 200, and naturally we were way below average with volume because of the shortened day. We're getting extreme with the 20-period moving average. We're just a little bit above 80 with the 50-period moving average, where we were flat with the 200-period moving average. And then our usual charts, the Stochk RSI showing good positive momentum, possibly extreme. The Williams percent R is extreme. The CCI 14 ticked back up a little bit here, and the CCI 20 is also extreme. All three stochastic time frames continue to be extreme positive. And we're above the midpoint and going back up with the force index. Short-term trends still looking positive, getting quite a bit of ways away from the double and triple exponential moving averages here. But for right now, it's looking positive. And here's the standard deviations chart. I don't remember a time, at least on this chart, where we were ever above that. Well, we were actually in the +4 channel here, which I don't include on this chart. And intermediate term, the balance of power is still well above zero, looking positive there. And then the 10, 20, and 30-period moving average study, looking good with all the lines going up. CMB composite is above the black line, and I put the black line on here, and I like to mention this, that there's nothing magical about that. I'm just using it as a visual reference point, but that's extreme positive. We're positive with the no-go-go no go. Okay, go, no go with the darker blue bars. We're even outside of the upper highest high value here. That just shows, okay, just everybody just get into the market right now. And sometimes that can be a little bit scary what happens after. All right, and then another thing here with the Landry Light, we're positive, but you see this dashed line here? We've been going above the dashed line now, and these are just, again, reference points to say that maybe this has gone on for a little too long, and now we're going up a little too much right now. So this is actually starting to look overbought. And we're still positive, though, with the proper order charts. We're just a little bit below the black line with the TTM squeeze. Again, another arbitrary line that I put on here for a reference point. If we go above the black line, then we'll be extreme positive. But for right now, it's positive. Still, the rate of change, still giving us very high readings because going back 50 periods is coming into much lower values. Getting above the moving average with standard deviation as the market has really started to move. And we saw this really starting to come up about this time we started to go back to trending. But not much of a change here. We ticked up a little bit with the ease of movement. We're still just kind of skirting along positive, but not very far above zero. The Arun ticked back up, but not as extreme positive now with the oscillator. And we're getting extreme here. We're getting above the 60 level with the McClellan oscillator for the S&P. It could go higher than where it's at right now. What we'll be watching for is if this continues to go up and then it starts to come down, but yet we make a higher high with the S&P, that's when we start to see a negative divergence. This is similar to what we were seeing here, where we were making a lower high here, and then we just spent quite a bit of time going sideways with a slight drift higher. And this is where the market, yeah, it wasn't really trending during this time, but it wasn't turning all that negative either. And we're going up with the summation index based on price and volume. We are still positive, but not extreme with the NYSE McClellan oscillator. So we're still going up with the summation index based on price and volume for the NYSE summation index. Swindler trading oscillator going up based on price and volume. That's positive. Above the moving average and getting quite extreme here. Again, it doesn't necessarily mean a reversal. It just might mean a slowdown. We had a real high reading right at the end of 2023. We did see a little bit of a decline coming into the first part of the year, but we'll see how prices hold up. But for right now, we're positive, both looking at price and volume. A little bit of an improvement after pulling back with the PMOs that are rising. The buy signals continue to go up, and we're going up with the PMOs that are above zero. Positive with the Elder's Impulse system. Positive with the Parabolic SAR. Extreme positive since we're above the green line with the slope oscillator. Positive here with the MACD, and not necessarily extreme. It's giving us a high reading, but not as high as what we were getting as we were coming up out of the April lows. So short and intermediate term, positive with the slope and TSI. Positive with the MACD, PPO, and PMO, or PMO and PPO. We're starting to come back up here. We're just about at the green line and just about at the moving average with the tricks. We're just still a little bit below the moving average here with the KST. Positive with the Copic Curve momentum oscillator. And coming back up, not quite up into the dark green area, but we're into this other green area with the Sean trend meter. Still above 50 with the money flow. Still extreme positive here with the ultimate oscillator. Still above an advancing moving average with on-balance volume. Still above the upper Bollinger Band here as well. It just means we've been moving pretty quickly lately. Once we finally started to trend again, we are extreme with the intermediate term RSI and the short term RSI. Intermediate term trends still looking really solid here. The red line and the blue line are going up and prices above both. We're above all the moving averages, and the moving averages are turning and starting to come back up as well. But we're far away from the 20 and 50 period moving averages as measured by the boom indicator. Extreme and showing some improvement with the bullish percent index. We don't have a lot of room left to go, but it was encouraging because after Wednesday, this actually came down a little bit, but it didn't drop below its moving average. It's now starting to look a little more positive, but it's extreme positive. And we're going up with the NYSE bullish percent index, and we're extreme positive and actually rolled over a little bit with the NASDAQ 100 bullish percent index. And we finished up the week with being positive 1.72%. And this is still a pretty healthy looking weekly set of bars here. Higher highs, higher lows for the most part as we were coming up out of the lows from April. Positive on all trending aspects here. The Heiken Ashi is positive, the Kegi chart is positive, the Renko chart is positive, and the three-line break chart is positive. Long term, really coming up with the 150. Now we're a little bit concerned if we get up to this red line, that means we're starting to look overextended with long-term moving averages. But for right now, they are still positive, well above their midpoint and advancing. And I don't know why they still have the small caps. They're above their 200-day moving average when we look at the IWM, which is the Russell 2000 ETF, small caps. So that should be positive. And positive across the board with commodities. We've gone back to just being positive with bonds in the short term. Stocks are positive across the board. The dollar continues to be negative across the board. And we saw staples, that's a defensive area, and materials took a bit of a hit, but even they were down not very much. We had tech leading the pack, and that's what we want to see in a more positive environment. Discretionary was up, that's a growth area, as is communication. And having all three of these, it'd be nice if they were near the top, but still having them positive is good, with the financials showing some strength as well. Nothing but green here. Utilities had a BPI cross above 50 because they crossed below 50. Materials had a BPI cross above 80. That's more economically driven, and that's showing some strength. Staples, well, it's more defensive, but they crossed back above 50. We had the Dow getting, the S&P getting above 6,200, and then ultimately closing at a new all-time high. Canada set another new all-time high. NASDAQ got above 20,003 here, and then communication, a growth area, a BPI cross above 70, showing good strength. NASDAQ and NASDAQ 100, which is not on this list, setting an all-time high and getting above 20,400. A lot of green here, a little bit of red over here in the more defensive areas like real estate, staples. But when you have all three big boxes here that are positive, that helps the market. Discretionary, Amazon, Tesla was down a little bit, but then we saw Google and Meta being up on the day. Looking better here, coming a little bit closer when we look at the weighted versus equal weighted version of the S&P. And I wanted to show this. I usually show this over the weekend, but this is a bit of a negative divergence here. We're setting a new all-time high with the equal weight version of the QQQs, which is the NASDAQ 100, okay? We have not set a new all-time high, and we didn't set an all-time high back in February either. So we're close, and this is the equal weight. So if this could come back and set a new all-time high, that would be more broad-based and would likely be more positive overall for the market. The Dow coming up to this R1 point, but still it was up 0.77%. We might be getting close to a golden cross, but we're not quite there yet. We are positive with the diamonds when looking at the Elder's Impulse system. Here's the golden cross for the NASDAQ, setting a new all-time high and actually closing above this previous pivot point here. And we're positive with the NASDAQ with the Elder's Impulse system, setting a new all-time high with the NASDAQ 100, recent golden cross. Also we're right about at this previous pivot point. Even though we passed them, they still can become influential. Positive with the Elder's Impulse system for the Qs. Momentum is positive, but not overly positive right now. And this is the long-term trend line with a weekly chart of the NASDAQ 100. We're starting to go a little bit above this trend line now. What I've been trying to point out is we might hit the underside of this and it may end up providing some overhead resistance. We have gone above it before, so we'll see if we're able to get above it again. Small caps above their 200-day moving average with the S&P 600 and with the Russell 2000 small cap index. Positive with the Elder's Impulse system for the small caps. We were up with the mid caps and positive with the Elder's Impulse system for the mid caps. Financial sector up over 1%, setting a new all-time high for the sector. The bank ETF has really been showing some strength. Now, they had that stress test a week ago, Friday after the market closed, and all the big banks passed. And so they've been kind of riding that wave, even though there's a lot of debate about whether that stress test really tests what it's supposed to be testing. But the market seems to like that. So we're seeing some nice bounce out of the bank ETF. Financials, they're not really outperforming the S&P, but they're they're doing well. I mean, they're setting an all-time high in the sector and we did bounce up off of this 200-day moving average with the ratio. Then the broad market measure, the Wilshire recent Golden Cross setting an all-time high. Total U.S. stock ETF, Golden Cross, all-time high. Excuse me. And we're setting a new all-time high with the FANG index. These are the really big stocks. Apple was up 0.5%. It's been trying to claw its way back to some improvements there. Amazon getting really close to a Golden Cross. Not quite there yet. Microsoft back up. Not sure if that's a closing all-time high, but it's really close to that. It's been a better performing stock lately. And Google was up 0.5% above both moving averages. Meta was up 0.75%, but not at an all-time high, but did generate a recent Golden Cross. Tesla virtually unchanged, and we're seeing price and both moving averages kind of all coming together still. And Nvidia, recent Golden Cross, up 1.33%. I believe that would be an all-time high. Netflix up, but still has a ways to go to get back to its all-time high. And then the semiconductors, recent Golden Cross, setting an all-time high. Then the SMH semiconductor ETF, recent Golden Cross, new closing all-time high, getting well above the rainbow and looking solid here. And then we look at different ratios. Now this top one, and I go over this in the weekend video as well. The top one is a weighted version of discretionary to staples. And see how it's kind of languishing here? That's because Tesla is a big part of the weighted version of the discretionary sector. Where when we take an equal weighted look at this, we're seeing some more improvement. It's actually starting to break out. We're also improving when we look at tech versus utilities. Not really breaking out yet, but biotech is improving compared to healthcare, and we are starting to break out when we look at hotels versus utilities. And then the bellwethers here, showing some improvement with the semiconductors, really doing well lately. A little bit of a bounce back here with the home builders, but then they've been going sideways since then. Transports are showing a little bit of strength, as is retail, and then regional banks are showing some recent strength. Then looking at this other chart of bellwether measurements, it says this breakout isn't just about one sector. It's a sign of confidence across the board. When the most important stocks in the market are breaking out as a group, that's a powerful message. And here we have the little cup and handle and the handle and a cup. And this is just showing more broad strength in the market. Seeing a little bit of an improvement with the correlation between U.S. and world stocks, a little bit of a drift lower, but sideways for the most part with the long-term correlation. And I have to clear my throat again. Excuse me. And then oil was down almost 1%, getting down into the lower end of the 60s range. The dollar continues to go down. And then looking at the latest reading from Truflation, coming in still under 2%. It did come up a little bit. It saw some strength in the economic reports that came out, but it's still under that 2% reading, where we were back up with the 10-year yield here, but we're still below that 4.5% level. And we declined. We spent the last couple of days declining now with the 10-year based on price. When we're back to even, when we look at the 10-year to 3-month yield curve, it's at double zeros now. And a little bit of an improvement with the Qs to S&P growth to value ratio, still under a declining moving average with discretionary to S&P, but we're seeing some improvement there, but we would like to see this do even better. And we are bouncing off of the moving average when we compare large cap growth to large cap value. So coming back up to the moving average with the large caps, a little bit above the moving average with the mid caps, turning up, but still below the moving average with the small caps. Still going up, showing that the S&P is outperforming utilities, which is positive. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So the outlook for Tuesday, and I forgot to take this out. So in case you haven't experienced Thursday yet, which you already have, the market will be closing early, but we are positive on all time frames with a trend now. There's going to be no economic reports on Monday, so that ought to make things rather interesting or very uninteresting. The geopolitical things, Again, I hope none of that comes about, but let's just hope that the 4th can be a happy weekend for everybody with lots of celebration, barbecues, getting together with friends, and fireworks that don't hurt anybody. All right, here is the economic calendar for the upcoming week. Nothing on Monday. We'll get consumer credit on Tuesday. And then we're going to get the meeting minutes on Wednesday. And then probably the biggest report is going to be initial jobless claims, which will come out on Thursday. So it's pretty light compared to what we just came through. There's also a look at the other calendar here. There's a bond auction on Thursday. I usually don't pay much attention to those. There's also one on Wednesday. I only pay attention to those if there's like a positive or negative reaction, and then bonds react to that. All right, seasonality, neutral to positive with the Dow and S&P for July. This should be the 7th. Sorry about that. And we are positive with the NASDAQ. And then we're coming out of some post-election year typical seasonal weakness. You wouldn't know that by what happened this week. Where now, for the first part of July, going up until about options expiration, which will be on the 18th, we do see positive seasonality. And we're also seeing that here in this chart as well. First half of July tends to be the best performing half of the month going back to 1950. Best part of the month for the whole year. And this is where we're coming into some positive seasonal time according to the Stock Traders Almanac. All right, so really we have our long-term special K chart. That's still negative, and we're still negative with the discretionary to staples ratio. But we're spending a lot of time above both of those moving averages, so that might change at some point. I do get a little bit nervous when this list is not very long. And I get a little nervous when the next list is very long here. Our 3 smart money indicators are positive, where it was flat with the Chaikin money flow, and we're getting extreme with the Chaikin oscillator. And the longer term trend of the growth to value ratio for the S&P is still positive. Our NYSE and S&P McClellan oscillators and summation indexes are positive, with the S&P now looking extreme positive. Parabolic SAR is positive, as are the bullish percent indexes, but we're extreme. Even though we declined a little bit with the NASDAQ 100, we're getting more extreme with the S&P. The swell trading oscillator is positive. The oscillators, we are really improving with the long-term oscillators, but not quite positive yet. The Copic curve is also positive. The ease of movement, money flow, ultimate oscillator is still extreme. The vortex is positive. The financial sector is positive, and the momentum, not real solid momentum, but we're still seeing positive momentum for the NASDAQ 100. Here are the pivot points for Monday's session. So our conclusion, no changes overall. We're positive, we're trending, and we're looking good on all time frames for right now. But you could make a solid case that we are getting overbought. Thank you. Again, have a wonderful holiday weekend, and I will talk to you in the next video.